Good afternoon. My name is Katie Scott. My other group members are Austin Jackson and Hannah McCamey. We're going to discuss our analysis of the WorldCom case study. Here you have the chain of command to whom Cynthia Cooper reported. Cynthia reported to Scott Sullivan, the CFO. She was the director of the internal audit department that consisted of 24 employees in total. Sullivan kept the internal audit on a short leash, only instructing them to conduct certain audits on his time schedule, but this did not stop Cooper from conducting her own audits that revealed questionable things. At this time in 2002, there were no legislations that protected whistleblowers or anything like that, so she ultimately made the choice to bypass her boss and perform a full financial audit. With the help of Gene Morse, they were able to find evidence for fraud involving capital expenditures and accrual releases. In 1983, it all began when AT&T broke up, and by 1894, Long Distance Discount Services was formed and began operations. As they started to grow, they handed the reins over to Bernie Ebbers because he displayed the ability and drive to grow the company, even though his resume contained jobs such as car salesman, milkman, bartender, and truck driver. Doesn't sound like the man I would want running the show. But by 1995, they had gained market share by acquiring multiple small telecommunication companies and were the fourth largest long-distance carrier in the U.S. They were expanding internationally, and that's when they decided to change their name to WorldCom. In 1997, they then bought MCI, the second largest long-distance company in the country, for the highest takeover price in history at $42 million. WorldCom was expanding and using their strategic growth plan to keep acquiring other companies. In 2000, they hit a wall, though. They had reached their largest capacity and were denied the request to purchase Sprint. Evers did not know what to do. He only knew acquisitions, and one employee stated, Evers appeared to lack a strategic sense of direction, and the company began drifting. During that same year, in October, Buddy Yates called Betty Vinson and Troy Normand into his office to instruct them to release $828 million of accruals. They were shocked by the order, were reluctant at first, but were reassured that it was only a one-time transfer. Mid-2001, Cynthia Cooper conducted her routine operations audit of capital expenditures, which raised some questions. In March 2002, the head of the wireless business unit complained about a $400 million accrual that had been used to boost earnings. Sullivan and the external auditors, Arthur Anderson, persuaded him that the transfer was properly classified. Also, in that same month, the SEC wanted to know just how WorldCom was doing it, so they requested additional information. Cooper and her internal audit team had begun a full financial audit. They discovered $3 billion in questionable expenses and went to question others. With not many answers, Cooper decided to meet with the audit committee to report her findings of inappropriate capital expenditures. The board then requested Sullivan and Myers to resign. That same week, on June 25th, WorldCom released a statement that they had inflated their profits by $3.8 billion over the last 2 years, and as a result, NASDAQ stopped trading and their credit scores fell drastically. As the investigation continued, over the course of the next 4 years, these 6 employees were convicted on charges of committing fraud: Myers, Yates, Vinson, Normand, Sullivan, and Evers. The major players resided in the general accounting and the internal audit department. Myers and Yates placed tremendous pressure on Normand and Vinson to make fraudulent entries even though they did not want to. The internal audit department was led by Cynthia Cooper. Cooper and Morse were the ones to discover the fraud being committed by WorldCom. We can't forget about Arthur Anderson, the external auditors, because there was conflict of interest with them. Because WorldCom was their most profitable client, they ignored the high risk factors, lowered their fees for WorldCom, and was too easily persuaded to believe everything top management told them. There's a pretty much agreed upon definition of fraud. In an article by Rasha Kamel, fraud is defined as material false statement with the intent to deceive, a proof that the victim depended on the false statement, and damages occurred as a result of victims' reliance on those false statements. It is outside the limits of GAAP and is breaking the regulatory framework. It's illegal. Earnings management is a little harder to define. Komonakos stated that earnings management is the process of taking deliberate actions within the constraints of GAAP so as to achieve a desired level of reported earnings. As long as you disclose the proper methods of accounting used to formulate financial statements, it is acceptable. But the problem comes when you fudge the core numbers with the intent to deceive. From an article by James Duncan, he defined 20 pressures for managers to cook the books. He starts with the external factors that include analyst forecast, competition, stock market growth or decline, and political motivations. These are out of managers' control, and when coupled with internal pressures such as management compensation and personal factors, it gives rise to the first aspect of the fraud triangle, which can lead to the other two aspects, rationalization and opportunity. For WorldCom, the external pressures present were competition and performance indicators. The economy was hitting a recession, there were new entrants to the telecommunications market, and it forced them to lower their prices. WorldCom was a public company and had performance indicators such as pressure to meet for external analysts. There was pressure to keep investors satisfied, one figure being the ER ratio, even as their competitors began to decline. Internally, WorldCom was a mess with no control environment. The pressures were created by top management when they made lofty goals like to be number one on Wall Street. Betty Vinson was someone who fell under pressure from Sullivan, but you can't deny her personal pressures to provide for her family, pay for her family's insurance, and keep her job as another aspect of internal. The fraud triangle is composed of three factors. Pressure is the motivation to commit the fraud, which we discussed on the previous slide. Opportunity is the ability to commit the fraud, conceal it, and convert it for deceptive gain. And rationalization, the justification for fraud. At WorldCom, all three were present, and because segregation of duties and internal controls did not exist, as well as having a board of directors that lacked knowledge about the industry, this allowed Sullivan to deceive them about financial standings. Lastly, the rationalization or justification for fraudulent actions. Like we've learned in class, for many perpetrators, it is their first time to commit any kind of crime. Because most of the perpetrators at WorldCom had climbed the ladder of success and sat very high in the rankings, they had reputations to maintain. They were able to justify their actions because of the pressures and opportunities present. The corporate culture at WorldCom was one of the biggest red flags to me in this case. First off, they grew so fast that they had offices all over the U.S. As you can see on the map, their corporate headquarters was in Mississippi, and other offices were located in Florida, Texas, and Washington, D.C. Each department had their own rules, and there was no centralization of authority. Within this same framework of chaos, Ebers quoted that a corporate code of conduct would be a colossal waste of time. This was before SOX required a code of conduct for public companies, and we have WorldCom to thank for a lot of later legislation around accounting. Listen to this quote. "If you show those damn numbers to the effing auditors, I'll throw you out the window." That's a very serious threat that Gene Morris received from Buddy Yates. Yates was not the only forceful and aggressive guy at the place, as other managers instructed employees to remain silent and secretive if the auditors were ever to question them. Top management demanded those under them to do what they say, which resulted in a hostile environment. One of the first things Cynthia Cooper uncovered was the entry booked to prepaid capacity. When she questioned the director of capital expenditures and Betty Benson, they didn't have an answer. They passed the buck. Eventually, when Sullivan pleaded his case, he defined it as unused or excess network capacity. After Cooper's findings, she defined it as being designed to represent the cost of leasing fiber optic lines that had fallen out of use in the wake of the telecom bust. I believe that prepaid capacity was the means by which WorldCom boosted its profitability artificially by moving money from the income statement to the balance sheet. How did the fraud improve the financial position? So we know that they desired to maintain a high growth rate for revenue as well as a steady rate for expense to revenue ratio. When you look at these figures, you can see that WorldCom consistently reported around $4 billion of line cost expense for each quarter in 2000 and 2001, represented by the blue line. On the chart to the left, you can see the blue line represents the reported income on the annual report. By understating their expenses by $3 billion in 2001, they were able to inflate their income by the same amount. They completely falsified their financials in order to keep profitability ratios high, and by doing so, kept investors and analysts happy.
Many people were affected by the WorldCom fraud. First and foremost were the employees. Approximately 30,000 employees ended up losing their jobs due to the scandal. Not only did these employees lose their jobs, they also lost their 401ks and pension plans, which were heavily invested in WorldCom stock. This fraud forced thousands of veteran workers to essentially start their financial lives over again at square one. Secondly are the investors in WorldCom. When WorldCom was at its height, the stock of the company was worth $180 billion. After the scandal came to light, the stock price became completely worthless almost instantly. This caused millions of people to lose all of the money they had invested in the telecom giant. Finally, there are creditors of WorldCom. When WorldCom filed for Chapter 11 bankruptcy, it had roughly $35 billion worth of debt on its balance sheet. Much of this debt came from different sources such as bondholders, banks, and vendors who perform services on credit. It is clear to see that the exact number and extent to which people were affected by this fraud is immeasurable. Because a financial scandal such as this can hurt the lives of so many individuals, it is important to place as many policies and procedures in an organization to minimize the risk of fraud. One of the main reasons this fraud was not detected earlier is due to the extremely poor internal controls of WorldCom, coupled with an organizational culture which incentivizes financial misconduct. The lack of internal controls allowed the top executives to manipulate their employees in order to change the financial statements. Once the financials were altered to their liking, the CEO and CFO were able to withhold information from internal auditors as well as external auditors. Once they had lied to the auditors, all they had to do was get past the board of directors. The top executives did this simply by creating false quarterly reports and presenting them to the boards. It is clear to see that the culture of extreme autonomy mixed with a lack of internal controls allowed this fraud to take place. The implementation of the Sarbanes-Oxley Act introduced new processes and standards to help ensure that these high-level frauds are prevented or at least detected before pervasive damage is done. SOX established the Public Company Accounting Oversight Board. The PCAOB helps to keep the independent external auditors accountable for the audits they perform. The PCAOB essentially audits the auditors to ensure that best practices were used over the course of the audit. Sarbanes-Oxley also required external auditors to search for and report any material weaknesses in the organization's internal controls. This alone could have helped detect and prevent the WorldCom scandal. Finally, independent auditors must now opine on the internal controls of all public companies. These three things combined could have helped prevent the WorldCom fraud. When the head of wireless business approached Cooper about the $400 million adjustment to boost earnings, Cooper took the issue to CFO Scott Sullivan, who attempted to bully Cooper into dropping the issue. However, what Sullivan didn't realize is that Cooper was seemingly the only person at WorldCom who wasn't afraid of the CEO or CFO. That is when she instructed one of her senior auditors, Gene Morse, to use his technical computer skills to dig deep into the company's computerized accounting records. Gene worked many nights trying to find evidence of financial misconduct, all the while saving any incriminating evidence so that the company could not subsequently destroy it. Once the internal audit department had uncovered the fraud, Cynthia Cooper and Glenn Smith, another one of Cooper's senior auditors, went from door to door asking for support for certain transactions. They started at the head of the international accounting department and moved all the way up to the controller until they got the answers they were looking for.
In hopes of deterring Cooper from finding evidence of fraud within the company, Sullivan used many forms of intimidation. Initially, from the beginning of the internal audit, Sullivan tried to restrict its scope. Instead of conducting an extensive operational audit, Sullivan urged Cooper to look in depth in certain areas in spending. Also, Sullivan did not allow external auditors to speak with or share information with the internal audit team. When Cooper or anyone else on the team would ask Arthur Anderson questions regarding WorldCom, they refused to speak with her, claiming that they took orders only from Sullivan. After hearing that Cooper had sought information from the external auditors, Sullivan confronted Cooper outside of the office and yelled at her for asking the auditors about the capitalization allowance in question. Next, when Cooper brought her questions and concerns to the audit committee, Sullivan told her to stay away and screamed at her in a way that she had never been talked to by anyone before. While Sullivan tried his best to keep Cooper out of his business, his intimidation ultimately failed. In an interview with Fraud magazine, Cooper recalled advice that her mom had given her in grade school. Her mom always reminded her to not ever allow herself to be intimidated. Because of this life lesson, Sullivan's persistent attempts to dissuade Cooper from digging deeper piqued her interest even more. Cooper said, "As an auditor, when someone is hostile or acting in a manner that is out of character, you should ask yourself why." When asked if she would do everything over again, she replied yes, it was the only right path to take. With the discovery of fraud at WorldCom, Cooper was faced with many ethical issues. The first was intimidation by her superiors. Her superiors, especially Sullivan, tried to enlist groupthink, rationalization, and fear to try to deter her. Second is the idea that whistleblowing can sometimes be a career suicide. More times than not, whistleblowers have been known to not come out on top. This action has led to unemployment, anxiety, marital problems, psychological problems, and weight loss. Cooper recalled that it was by far the most difficult thing she has ever been through, and because of this, she suffered depression and major weight loss, among other things. Third, Cooper was faced with choosing between loyalty to the company versus loyalty to ethics. She had worked at WorldCom for 9 years and knew her coworkers and superiors very well, and because of this, it made it hard for her to choose doing the right thing over protecting people in her company. Fourth, Cooper had a personal history and attachment to WorldCom in the local community, for her hometown was Clinton, Mississippi, WorldCom headquarters. Finally, people close to her would be affected negatively if fraud was brought to light, for her own parents owned WorldCom stock. Because Cooper was a CPA and an internal auditor, she had 2 different organizations and codes of ethics that she was bound to and obligated to withhold. The first is the AICPA Code of Professional Conduct, which includes responsibility, public interest, integrity, objectivity, and independence, and due care. The IPPF Code of Ethics includes integrity, objectivity, confidentiality, and competency. Cooper was obligated to many different parties, including shareholders or investors, the board of directors, creditors, the government, and regulatory agencies. In my opinion, there are 4 alternative courses of action that Cooper could have taken. First is that she could have done nothing. She could have done as she was told from the beginning and not expanded the audit to look for fraud in the first place. The consequence of this, however, is that the fraud would have continued undiscovered and she could have been implicated for not finding the fraud later on. The second alternative is that once Cooper discovered the fraud, she could have gotten in on it too. The consequence of this is that fraud would have continued and she would have been found guilty for collusion to commit the fraud. Third, she could have stopped the investigation after being intimidated and confronted by Sullivan. The consequence of this would be that the fraud would have continued undiscovered and she would have been implicated for doing nothing when she knew something was going on. Finally, Cooper could have told Sullivan that she was investigating further. However, this consequence is that it would have raised suspicions and given the perpetrators time to cover up the fraud. Ultimately, Cooper chose to discreetly investigate the fraud further and blow the whistle when she found significant evidence of fraud. She chose to do this because she was taught not to be intimidated, she had a strong character of integrity, did not want to regret her decision, and she believed there was only one right path to take. Betty Vinson was both a victim and a villain of this crime. She was a victim because she was pressured by her superiors to take the actions that she did, and she felt trapped. On the other hand, Betty was a villain because she rationalized her decisions. She told herself every time that she made an illegal entry that this was going to be the last time, yet it never was. Also, she did not have another job, and this job paid too well, more than her husband's, to give up. She allowed herself to believe that Sullivan knew what he was doing and believed him when he reassured her that she was doing what she was doing was not illegal, even though she had a bad feeling about her actions the whole time. She knew what she was doing was wrong, yet she allowed herself to rationalize everything and continued to make the illegal entries. Arthur Anderson is another blameworthy party. It turned a blind eye in order to keep a long-term relationship with its most highly coveted client and its crown jewel. Because Arthur Anderson strove to keep this relationship in good standing, it underbilled WorldCom to show its investment in the company. Among other things, it did not object to WorldCom withholding important information because it didn't want to risk losing it. Even though WorldCom was truly a maximum risk client, Arthur Andersen continued to audit it as a moderate risk. It did the same test every single year and continued to ignore red flags of fraud because it did not want to risk losing its crown jewel. Because of these things, Arthur Andersen is just as much to blame as WorldCom for the fraud. While WorldCom did withhold information and present altered documents in order to mislead Arthur Andersen, it is still to blame because it did not uphold its responsibility and obligations as an accounting firm. The board was another blameworthy party, but to a lesser degree. It consisted of 50% non-executive members made up by former owners, officers, and boards by other companies it acquired. CEO Evers presided over the meetings and determined the agenda. The board only met 4 to 6 times a year, and they are to blame because they were too distant and detached. They played far too small a role in the life, direction, and culture of the company. Even though they were misled by Evers and Sullivan because of manipulated information given to them, this would have not happened if they had been more involved with the company. However, when the board was confronted with evidence of fraud, they took immediate and appropriate action by requesting the resignation of both Myers and Sullivan. There are 6 lessons to be learned here. First is to focus on the long term. Do not succumb to pressures of meeting Wall Street expectations, and don't live by the numbers too much because this incentivizes the wrong types of behavior. Second, employ more independent and involved board of directors. Evers and Sullivan were able to use their position to manipulate and mislead the board. Third, cultivate a better corporate culture. Fourth, know where to draw the line. Fifth, fraud will always catch up to you. And sixth, if you have to. Here is our works cited, and works cited continued, and that is the end of our presentation. Thank you.